I'm Jespo Mullen, head of the IEA's communications team, and I'm joined today by IEA Executive Director, Dr. Fatih Birol, and the lead authors of the World Energy Outlook, who are our Director of Sustainability, Technologies and Outlooks, Laura Cozzi, and our Chief Energy Economist, Tim Gould. I'd like to note at the start of this event that the World Energy Outlook 2023 is available to read and download in full on our website. So if you haven't done so already, we encourage you to take a look. During today's event, Dr. Birol will provide some opening remarks, and then Ms. Cozzi and Mr. Gould will present the key findings of the report. We'll then take questions from journalists. For the journalists taking part in this press webinar, we invite you to send your questions via the Q&A function in the Zoom. You can do this at any point during the presentation, and we'll also take a 2-minute break right after the presentation for you to send your questions. And with that, I'll hand over to our Executive Director, Dr. Birol.
Thank you very much, Jetro, and greetings to everybody from the International Energy Agency headquarters in Paris. As my colleague, Mr. Mullen, mentioned, we are here to present the 2023 edition of our flagship publication, World Energy Outlook. Dear colleagues, this is an annual opportunity for the International Energy Agency to see where the world energy is heading and what is the state of play in the global energy markets. And the World Energy Outlook provides insights to these issues. And this year, as many of you know, as we read in the newspapers and several institutions do remember that this year is the 50th anniversary of the first oil shock, which had devastating effects for the global economy. And yet, dear colleagues, we are today facing a major geopolitical crisis in Middle East that could shock oil markets once again and deeply. Because many oil producing countries are in that region, and there are a lot of discussions if these countries are part of the crisis, if this trade route is closed or not closed. These are rather difficult questions and poses serious risk at the global oil security. And this comes on top of the insecurity that we had in the natural gas markets about 2 years ago after the invasion of Ukraine by Russia, at that time, #1 natural gas exporter of the world. Looking at these facts, how oil and natural gas markets are interwoven with the immediate geopolitical risks, I think it will be difficult to say that the oil and gas represent safe and secure choices for the consumers, for the countries worldwide. And these issues, geopolitical risks, of course, come together with another risk, which is the very fact that the climate change, the climate crisis today is more and more pronounced. As the scientists say, this year, 2023, said to be the hottest year in the history, which is driven by the use of fossil fuels. In this context, World Energy Outlook looks at the future based on thousands and thousands of energy, economic, financial data, and I would like to thank here my colleagues Laura Cozzi and Tim Gould and their big team, the famous World Energy Outlook team, to brought this report together and provide insights for the future. When we look at what the World Energy Outlook claims, I think there is a very legitimate reason to be hopeful about the global energy markets. For example, the first message I wanted to share with you today is that the WEO, as we call it, the World Energy Outlook, says that the energy world in 2030 will look very differently compared to today, only in 7 years of time. And there are many important data in the report. I invite all of us to look at them carefully. And I chose 4 data points in the different parts of the energy production and consumption, how the 2030 will look different than today. Number 1, in the transportation sector, which is very important for energy consumption, for emissions, for oil security, and oil demand as well. In terms of electric cars, dear colleagues, 2 years ago, only 2 years ago, 1 out of 25 cars sold in the world was electric. 1 out of 25. This year, 1 out of 5 cars sold is electric. And in 2030, almost every second car sold in the world will be an electric car. And these numbers are based on the current policies of the governments. For example, there may be some additional policies from governments to continue to support the clean energy, electric cars and others. Of course, this will make the numbers even more pronounced. So this was one number on the electric car. The second, on the electricity generation. Very strong growth coming from solar, wind and the others, the renewables, are pushing the fossil fuels out of the electricity generation globally, slowly but surely. 10 years ago, 70% of the global electricity generation came from fossil fuels. This year, after 10 years, this year, it is about 60%, the share of fossil fuels in electricity generation. And 2030, even with the existing policies, the share of fossil fuels go down to 40%. A big change again in the electricity generation, pushing the fossil fuels slowly but surely out of the power system. Third, another example, home heating. It's a major source of electricity consumption in most parts of the world. And we see that the penetration of heat pumps and other electrical heaters, their sales do surpass the sales of fossil fuel boilers also within this decade, making it much more sustainable. So this is another example. Maybe I finish with a fourth example, how the world will look differently in 7 years of time compared to today is the investments. Let me take another renewable source, wind, offshore wind. This year, currently, the amount of investment going to offshore wind is about half of the investment going to coal and gas power plants. But it is changing. Talking with the investors, financiers, utilities, we see it is changing and changing fast. And in 2030, we see the amount of money investment going to offshore wind will be 3 times higher than money going, the investment going to the gas and coal-fired power plants. So these are all these numbers, in my view, very important changes in our energy system are based on the current policy settings. If the governments would introduce additional policies to support the clean energy transition, these numbers could be much more stronger. And these numbers I share with you and the other findings of the World Energy Outlook mean that we are going to see, after tens of years, the fossil fuel consumption this decade will peak. Coal, oil, and natural gas. Again, with the current policies in place without additional policies. So this is, I think, an important turning point for the energy markets, and something we are at the IEA looking at the consequences of it very, very seriously. Now, what does a peak mean? I try to explain you, and I want to say you what doesn't it mean. So this is important to make it clear. A global peak of fossil fuels doesn't mean that all the countries of the world, their fossil fuels will peak. For example, we see that especially oil and gas consumption will increase in several developing and emerging countries, while they see a sharp decline in the advanced economies. And it also doesn't mean that we do not need any more investment in oil and gas. We will still be using oil and gas, and if we want to reach our climate targets, less and less, but still we need that oil and gas to come to markets, especially given the fact that many oil and gas fields are in decline. So we need that money definitely less than today in order to have that oil and gas, declining amount of oil and gas come to the markets. And again, this peak, dear colleagues, we see doesn't mean that we are in line with our climate targets. World Energy Outlook expects that the global emissions will peak in 2025 and then decline slightly, but we are still, with the current policies in place, in line with the temperature increase 2.4 degrees Celsius, which is much higher than the scientists tell us 1.5 is the limit. So therefore, there is a need to have a much stronger clean energy policies. So this is the first message I wanted to share with you. The second message is in another part of our energy world. It is about the natural gas markets. We are in the energy world, we still have the fresh recent memories of the natural gas market tightness, if I may say so, and very high prices, volatile prices after the 24th of February 2 years ago. And this, of course, created a major sense of gas insecurity, high prices and volatile markets, and lots of gas supply security concerns. But World Energy Outlook, again looking at a project by project around the world, comes up with the message that around 2025 and after, substantial amount of new LNG capacity is coming to the market, mainly from United States and Qatar, but from other countries as well. And starting from 2025, the amount of new LNG coming to markets will be about 50% what we already have. And this will, we expect, have a impact on the gas markets around the world. And at the same time, this would ease the supply concerns and also put a downward pressure on the prices. And from that point of view, it is important for in our view, natural gas exporters need to think which destination around the world they would like to sell their gas, as it may have it may create challenges for the sellers, and the markets will go in the direction of being a buyer's market. Dear colleagues, I have two other points to make before I give the floor to my friends and colleagues, Lara Cozy and Tim Gould. There is one issue which is, in my view, and surprisingly, not much discussed, which is the issue of China. In the last 10 years, when you look at the last 10 years and the energy markets, if there is one country, okay, which determined the oil, gas, coal, and the clean energy trends, it is by far China. China's role in the energy markets is outsized. If I give you a few numbers, in the last 10 years, about 2/3 of the global oil consumption growth came from China. About 1/3 of the global natural gas consumption growth came from China. And almost all the growth in coal consumption growth came from China. And yet, Chinese economy in the last 10 years increased over 6% per year on average, which drove the strong growth of energy consumption. But now, China is changing. China changed the world in the last 10 years, and now China itself is changing. Chinese economy is slowing down, and Chinese economy is rebalancing. Chinese economy doesn't need much more steel, much more new transportation infrastructure investment, doesn't need much more new the stocks of housing, not much more cement. So therefore, the slowing down of the Chinese economy and rebalancing, we believe, will have major impacts on the demand for fossil fuels, and as such, it is another element to take into account when we look at the future of energy together with what is happening in the clean energy domain, if you want to understand the global energy markets in an objective and in a holistic way. I would like to finish my pickup from this very rich world energy outlook with one final remark. We are approaching the COP28 going to take place in Dubai only a few weeks from now. And one of the reasons why we decided to publish this World Energy Outlook earlier than our usual time is with the hope to provide a basis for the decision makers going to Dubai to see how the energy world, which is very important for climate change discussion, looks like. So we are working closely with all the governments who want to have a good result from Dubai, including the COP28 presidency, and we are thankful to all of the governments, including the presidency, for coming up with all these efforts to come up with some good results. From the International Energy Agency point of view, we work every single day on the energy and climate-related issues in order to consider COP28 as a successful summit, which we very much hope to see. We have 5 criteria. So number one, we would like to see that the governments around the world in Dubai agree to triple the renewable capacity between now and 2030. Second, we would like the governments to agree that they double the improvement of energy efficiency globally, again, between now and 2030. We would like to see oil and gas companies commit themselves to climate targets by taking some measures, including a major reduction in the methane emissions, 75% by 2030. Fourth, we would like to see that the advanced economies and in the international financial institutions do come up with financial mechanisms in order to support the clean energy financing in developing countries. Fifth, and the last criteria that we would consider COP28 to be a successful one is we would like to see that the governments in Dubai take measures, agree to take measures for an orderly decline of fossil fuel use, including no new unabated coal plants to be built. So these are the 5 criteria coming from the IEA, and we hope that these criteria will be fulfilled in Dubai, and we will have a good meeting as a world coming from Dubai with good results and give good news around the world. With this, if I may, with my thanks, I would now turn to my colleague, first to Laura Kozzi and to Tim Kult, but Tim wants to go first. Tim, why don't you go first, please?
Well, thank you very much indeed, Executive Director. When we were putting together this edition of the World Energy Outlook, we were very conscious of the risks that we continue to see to energy security, the fragility in energy markets, and also more recently, some of the echoes of the first oil shock 50 years ago. So we thought we'd begin with a few reflections on where we stand relative to the world of 1973. And what you're looking at on the screen now is the global energy mix 50 years ago and today. And it's immediately visible how some of the changes that were set in motion by the first oil shock led to a significant reduction in the share of oil in the global mix. And I think it's also interesting to consider these in absolute terms. And you can immediately feel how much the energy system has expanded over the last 50 years. And some 80% of that growth has come from outside the advanced economies. So it's come from emerging and developing economies around the world. And we see a similar dynamic when we consider what's happened to oil demand. Here's the structure of oil demand and that shift towards emerging and developing economies. And you can also see in absolute terms how we've seen almost a doubling in oil demand over the last 50 years. And one interesting data point, 1973, there were 50 million cars on the road around the world. Now, more than 1.3 billion. So well over 20 times more cars on the road now than there were 50 years ago. And comparing that shift with the shift in overall oil demand speaks to the way that the composition of oil use has changed, but it also speaks to the enduring importance of efficiency measures and more recently in electrification in keeping a lid on oil transport demand. And finally, wanted to show you some electricity data. This is the electricity generation mix worldwide. You can see oil exiting the system and renewables coming in at scale. And renewables now accounting for around 30% of generation. And that's up 10 percentage points from where we were 10 years ago. And that trend towards electrification and towards low emissions generation is set to continue. And I think that speaks to 3 important themes that we are picking up in this year's World Energy Outlook. The first of them is the enduring importance of energy security, and particularly for a new synthesis, a new alignment of energy security and emissions reduction goals as we move through transitions. Second, the shift in you often hear that the global energy mix is big, it's difficult to move, but shifts do happen, and they can happen quite quickly, especially after times of strain, after times of crisis. We saw that in the aftermath of 1973, and today we have a much larger range of cost-competitive clean energy options to choose from. And the final third point is it's going to take a much larger range of countries at different stages of development to solve our common challenges. And that speaks to the importance of international cooperation, which is another theme that we'll be coming back to.
Now, looking forward, it's very clear that we are going to look at some major transformation over the years to come. And we identify some key structural shifts that will make us live in 2030 in a very different world than today. The executive director mentioned the unstoppable growth of clean energy technologies. He mentioned the very large sales in electric vehicles, and this trend that is going to continue through the 2030s. But what will it mean in our lives? When we will be walking in the streets in 2030, you will actually see 10 times more electric vehicles than today. Importantly, we have been describing the clean energy transition up to now as another type of transformation, another addition. But what's going to happen this decade is actually this is going to shift from an addition to a substitution. What does it mean, this? You will see more electric cars, but you're actually going to start seeing less of the conventional vehicles that Tim Gould mentioned earlier. It means that around 2030, you will see more EVs and less conventional car running in our streets. This will have huge implications for oil markets. Now, this type of transformation of shifts from renewables to clean energy, away from fossil fuels, is going to be a common theme across many sectors. The key and front runner is clearly the power sector. We have seen again and again solar breaking records. Now, the turnaround is happening this decade. What turnaround? The turnaround is clean energy technologies actually accounting for the largest part of generation globally. Today, renewables account for around 30% of this generation. In 2030, they will account for 50%. But it's not only about renewables. Nuclear, we are seeing a pickup of those new additions. And together, all these clean energy technologies will reduce the share of fossil fuels, first below 50% and then approaching 40% in 2030s. Dr. Birol mentioned also transformations in the heating sector. So it's really going to be across the entire energy system, across the entire energy uses. So this unstoppable force of clean energy technologies is one of the structural changes we are identifying. There is another one, which is equally major, and is the Chinese economy is transforming. The Chinese economy is maturing. So China will add to the global economy as much as growth as it added over the past 10 years. But the type of growth that China will undergo, and is undergoing even now as we speak, is very different from what we have seen over the past decades. Is a growth that requires much less energy than in the past. So while producing the same new amount of value, it will require a fraction, just 10% of the energy that it added over the past 10 years. Now, as you're talking about the largest energy consumer in the world, this will transform and trigger through the entire energy system. So here you're seeing the type of change that China will go through, and this is what will mean for energy markets. China accounted for over 50% of the growth in global energy demand. What's going to happen to coal markets now? We are going to see two major shifts, one in the power sector, the other in industry, that are the core coal demand centers for China today. China added in the first 9 months of this year as much as solar as the entire world last year. This continued push for clean energy will see a turnaround in coal use in the power sector. Similarly, we are seeing similar transformation for energy-intensive industries. Dr. Birol mentioned them earlier, cement, steel, that will see again a peak and then a decline. As we are seeing at the same time, big growth in areas like semiconductors, solar PV, electric vehicles that require a lot of electricity. And this electricity is going to be mostly clean. Similar trends for oil. More and more electric vehicles are being sold. 38% of sales in September were electric vehicles. This is going to continue to grow and will lead to a peak in Chinese oil use by the 2030s. Natural gas is set to continue to increase, but at a lower pace than over the past decades. Now, when we put these major shifts, on the one hand, the continuous growth of clean energy technologies, and on the other hand, the transformation of China economy and energy, then this leads to peaks first in global coal use, then oil, and then natural gas. As you can see very clearly in this graph, it doesn't mean that the world will all look the same. Advanced economies will use less of fossil fuels, but emerging economies will continue to see those uses rising. India emerges as the largest clean energy growth center. The Middle East will drive natural gas demand growth. Of course, there are many uncertainties surrounding the outlook. Some of those you see them in the news on a daily basis, but we would like to bring to your attention one that is maybe less visible. We are seeing, and this you're seeing the example of solar, but it's true across different clean energy technologies. We are really seeing ample supplies of new solar coming to the market. The plans of manufacturers around the world are big. This is not a niche industry anymore. This is an industry with billions, hundreds of billions invested in capital. The size is similar to a quarter of the global car market, so it's huge, with millions of workers in it. And it's just set to expand to double from today's level. Now, if you look at our demand for those solar panels, they imply rather low output for those new plants. Today, the healthy part of the industry is actually seeing much higher than this 40% operations that this number would imply. They would see healthy parts of the industry see now 70–75% of rates. This would imply a much higher solar uptake, around 800 gigawatts. And why is this meaningful and important? This is meaningful and important because if you were able to absorb this potential production, then the outlook for fossil fuels will look different. In particular, for natural gas and for coal, both of them, we will see an even earlier peak and a faster decline afterwards. So this type of increases in manufacturing capacity, we are seeing them not only in solar, we are seeing them in electric vehicles, we are seeing them in batteries, we are seeing in heat pumps in certain parts of the world. So they do present an incredible opportunity to fasten even further the clean energy transition.
I'd like now to pick up the story with some words on natural gas, because a big change is coming in natural gas markets, as mentioned by the executive director, and it's coming from LNG. So back in 2010, LNG was already a big global industry, but it was dominated by point-to-point contracts between major exporters and importers. Now, if we fast forward to 2022, we had an industry transformed. Liquid, deep markets accompanied the growth of the US as a major exporter, and that was really a critical factor in enabling the world to ride out the storm caused by the cuts to Russian pipeline supplies. But gas consumers around the world were left with the bruises from a turbulent year. And for a moment, the conversation about gas continues to be around risks of price volatility and security of supply. But that is set to change. There's a huge wave of new LNG projects that have started construction or taken a final investment decision. That's an additional 250 billion cubic meters per year of liquefaction capacity by 2030. And that's equal to almost half of today's global LNG supply. And a particularly large increase starting in 2025 for a couple of years after that. So that eases price concerns, eases supply concerns, but Europe is not going to take more, and neither are the established markets in Asia. So high expectations from the global gas industry that emerging and developing economies, particularly in Asia, will need a lot more gas. And our projections show that to some degree, but they are more modest in our outlook. So there promises to be extremely strong competition among suppliers for these markets, especially if China's growth is weaker than expected. And those ample supplies of LNG in the second half of the decade, that has important implications also for Russia. It means very limited opportunities, in our view, for Russia to secure additional pipeline markets in Asia. So Russia's share of internationally traded gas used to be 30% in 2021, and this is halved by 2030. I'd like to say a few words also about the dynamics for global energy investment, because the changes that we've discussed have significant implications for the capital flows going into the energy sector. And what you're looking at on the screen is how the trend for fossil fuel spending has evolved in recent years. It's now at around $1 trillion per year. Now, we've talked about the end of the growth era for fossil fuels. That does not mean an end to fossil fuel investment, as the executive director mentioned. We continue to need investment in fossil fuels in all of our scenarios. That doesn't disappear overnight. The big question is how much. And that's perception, that analytical conclusion has shifted over time. If we look back at our projections in previous years, we did see that we would need an increase in oil and gas investment in order to balance markets in the stated policy scenario. That is no longer the case. And of course, we also need to focus on the glaring risks for the climate. So we need to accelerate the momentum on the clean energy side as well. And that's indeed what's happened. Since 2020, there's been an increase of around 40% in clean energy investment. And if you move this through to 2030 in that stated policy scenario, you can see that we'd be on track for spending of well over $2 trillion each year on clean energy by 2030. But if we want to get on track for a 1.5 degree scenario, that would need to double over this decade. So there's an urgent need to get more clean energy projects moving, particularly in emerging and developing economies outside China. And that's challenging in today's climate of high borrowing costs and elevated debt levels. But that's really the task that was mentioned that is also being taken to COP28 in Dubai. I'd like to also pick up a little bit the energy security theme and on some emerging challenges that the IEA is very focused on. So this figure shows a number of commodities that are either used directly as fuels or indirectly as inputs to crucial clean energy technologies. And on the vertical axis, that's market size. It's shown on a log scale. So we're moving from major global markets in the case of oil and gas to much smaller ones in the case of rare earth elements. And this is the situation in 2017. And it's immediately visible that the level of concentration is greater for most critical minerals than for oil and gas. You're showing on the horizontal there the market share of the top 3 producer countries around the world. And I want to zoom in on some of these critical minerals with a focus on the processed minerals. So concentration here refers to the processed or refined product, not the extracted ores. And between 2017 and 2022, 2 things happened. One is that the market for critical minerals is growing rapidly as clean energy transitions pick up speed, so the data points are moving up the screen. But the second thing is that they're moving generally to the right, so they're in the direction of greater concentration. So refined nickel, the market share of the top 3 producers rose from 45% to 66%. You also saw refined cobalt moving to the right on the screen. Other elements were high before and stayed there. How does this evolve to 2030? So we are starting to see more diversified patterns of investment coming through. But the majority of midstream projects are still being developed in today's dominant regions. That's true in the case of planned lithium chemical plants for China. It's true for planned nickel refining facilities in Indonesia. So we see some improvements in diversity when we look at all the announced projects, but this will take time. And that points to the continued need for vigilance and concerted efforts to diversify supply, to reduce potential vulnerabilities in clean energy supply chains. And it's a final word on that. It's not only a supply question. We need to focus very much also on innovation, mineral substitution, and recycling as elements of a critical minerals security strategy.
And what does this all mean for emissions and for climate change? So the executive director opened saying that 2023 is set to be the hottest year recorded in human history. Our projections for steps, so for without additional climate policies, imply a peak in emissions in 2025. Unfortunately, those peak in emission in 2025 don't translate in any cooling in the world. In fact, 2023 will result in being the coolest of the years we will see throughout this century. Even if emissions peak and start declining without additional climate policies, we will break record temperatures year after year after year. The only way to stop emissions from rising is to actually get to net zero emissions. So the only way to stop temperature from rising is to get emissions to net zero. And this is why we have released our net zero report nearly a month ago. The reason being that we still see a way to limit temperature increase below 1.5 degrees. Our executive director mentioned what are the key actions for us to look at from now to COP and beyond. So we are calling and looking at 5 significant actions that could give the chance for the globe to limit temperatures within 1.5 degrees. The first is really about the electricity sector, tripling renewable capacity. Of course, a pathway is going to be different in each country of the world. Some will increase nuclear, but the key point is reducing emission in the power sector. Doubling improvements of energy efficiency. Those 2 key actions, together with policies necessary to reduce fossil fuel use, will lead to the necessary decline of fossil fuel use to 2030, a 25% decrease. Limiting warming in the short term will hinge not only on actions on the CO2 side, but also on methane, where the role for oil and gas and the energy industry at large is incredibly important. We will be releasing a specific analysis on this soon, but the numbers are clear. At least 75% decrease in fossil fuel methane. Finally, something that we've been working on for years now and absolutely essential is going to see, we need to see a significant increase in financial flows towards clean energy in emerging and developing economies. To conclude, very clearly this WEO shows one thing, that for the 2 challenges that we are facing today, energy security and climate change, the long-lasting solutions to these double crises are the same, clean energy technologies, and they are here with us, ready to be deployed. Thank you.
Thank you very much for the presentation. We now have some time to take questions from journalists. So we invite the journalists in attendance to send your questions through the Q&A function in the Zoom, if you haven't done so already. And please do mention your media outlet along with your question. We're just going to take a 2-minute break to give you a chance to enter your questions, and we'll be right back.
Please come here to questions.
They have an iPad as well. So
They have iPad as well.
Yeah. Hi, welcome back. So thank you very much for the questions. We have quite a few to get through, so we're going to do our best to cover as many of them as possible. The first one, well, maybe we can take a couple at a time when there's some overlap in the areas, because there are so many. From Isabelle Anne from Libération in France, who asks, I'd like to know how you respond to OPEC's criticisms about IEA's peak oil assessment. Why are IEA's projections so different from the OPEC projections? We have another similar question along this lines from Aidan Kallick from Argus Media, and then also a question from S&P Global around oil security, energy security. What risks to energy supply and infrastructure do you see from the current Middle East crisis? So I think Dr. Birol will take those first couple of questions.
Okay, thank you. Maybe they are both oil and OPEC related, but maybe I start with our projections versus the colleagues from OPEC. I have no doubt that the OPEC colleagues are looking at the global oil markets from an objective perspective from their point of view. But our data shows that the global oil demand will peak before 2030, driven by what is happening on the clean energy technologies, especially in the transportation sector, and also economic shifts. As my colleague Mrs. Kozi explained in depth, Chinese economy is changing significantly, and China was in the last 10 years by far the single most important driver of global oil consumption growth, about 2/3. If Chinese economy slows down and change its structure and becomes a lighter economy, it is demand for oil will go down, and we know that China today produces about half of the, in fact, more than half of the electric cars around the world. So therefore, our expectation for global oil demand, looking at the clean energy and the economic prospects, is different than those of our colleagues in OPEC Secretariat. But we are always, of course, happy to discuss and compare notes. But not only because not only OPEC Secretariat Jethro, some oil companies, especially in North America, have similar expectations on the oil markets. My humble suggestion is that the oil executives around the world not only talk among themselves about the future of oil markets. I very much suggest that they have a dialogue with other parts of the energy economy, namely car manufacturers, the solar panel manufacturers, heat pump manufacturers, consumers around the world, and the investors. It may well lead to a better and, in my view, more balanced expectation of the global markets. The second question is about what could happen as a result of I think it was from S&P, if I am not wrong, in Middle East. Of course, we don't know. We don't know how the political situation will evolve there, but what we know is that the political tensions are very, very strong, and as it happens, about 1/3 of the global oil exports come from that very region. Not only major oil producers and exporters are there, but major trade routes are in that region as well. As such, the major geopolitical crisis there may lead to and once again an oil shock after 50 years we have seen, and we very much hope that it will not go there. There will be peaceful solutions among the parties, and that we don't see such volatility in the markets, which is a bad news for everybody, especially those in the developing and emerging countries.
Thank you very much, Dr. Birol, for those answers. So The questions continue to flow in. There's a few around investment, which I might put to our chief energy economist, Tim Gould. So one from Martin Mayrath, who I believe is with Courier in Austria. Which technologies are included in the projection of investments in clean energy technologies, 2 trillion by 2030 based on today's policies? Martin lists nuclear, carbon capture, etc. And how much of the expected investments is in renewable generation. We then switch a bit towards fossil fuel investment. Let me just find this one. A clarification requested from Rafiq Latta from Energy Intelligence. You said investment is still needed in fossil fuels, but does your recent call that no investment in new long lead projects still holds? So that was one of the key messages from our recent net zero roadmap that Laura Cozzi mentioned. And then one more just around, I guess, the future of fossil fuels from Nick Coleman at S&P. Asking, you have OPEC accounting for 45% of oil supply in 2050 under the announced pledges scenario. Can you specify the source of that production? Will there be a comeback by African producers, or will it be increasingly concentrated in the Middle East and the Gulf? So Tim, I've thrown a few balls your way. Let's see how your juggling is. Go for it.
Thanks very much, Jethro, and thanks very much to colleagues for the questions. If I take the last one first, if we look at our projections for OPEC production in that announced pledges scenario, then what we see in practice is we don't have much of an uptick from African producers. Their share falls over time. It's really those Middle East and Gulf producers that see an increased share in overall output. And then turning to the question from Rafiq Latta. So you said investment is still needed, but does your recent call that no investment in new long lead projects still hold? So I think we need to be careful here which scenario we're talking about in terms of the specifics, but in all of our scenarios, continued investment in oil and gas is needed. As I was mentioning, the question is then how much, and that really depends on how much momentum we have behind clean energy transitions. And so the point I was making during the presentation is that in the world that we see today, based on today's policy settings, momentum behind the clean energy transitions is sufficiently strong that a conclusion that we reached in the past no longer holds. So in the past, in that scenario, we found that we needed an increase in oil and gas investment in order to balance markets. That is no longer the case. So the amount that is being invested today in that stated policy scenario is the same as we would need in 2030. So that, when you hear organizations or companies talking about the need for additional investment, you could have that conclusion in mind. But if we were to get on track for a 1.5 degree scenario, so our net zero emissions by 2050 scenario, there too we would still need oil and gas investment, but we would need much less because the decline in fossil fuel demand, the declines in oil and gas demand are sufficiently steep in that 1.5 degree scenario that you could meet that demand through continued investment in existing fields, but no new long lead time investments. And so that's the way this plays out in our different scenarios. And I think there was one last question, which if I recall rightly was about what makes up our clean energy investment numbers, that we had $2 trillion in 2030 in the stated policy scenario, and how much of that goes to renewable generation. And the answer there is around $650 billion out of that 2 trillion is for renewable generation. And I think it's important to have in mind that renewable generation is only one part of that clean energy picture. One other part, which we've emphasized very strongly in recent weeks, is on the infrastructure side. We need to pick up the investment in grids, and there's a significant uptick required to 2030 in grid spending because as that analysis highlighted, there is 3,000 gigawatts worth of new renewable projects waiting in queues. And that could be unlocked if we accelerate the pace of change on the grid side. And alongside the power sector, we also have clean fuels, and we have electrification, we have energy efficiency, and that altogether makes up the clean energy investment numbers that you saw on the screen. Thank you.
Thank you very much, Tim, for covering that range of questions. And now we've got a few for Laura Kotze, our Director of Outlooks. One from Ronald Kim at Argus Media. In your stated policy scenario, unabated coal-fired power peaks in China around 2025 and shortly after 2030 in India. What would be the factors that could accelerate or delay this timetable? There's another question around demand in China and India, maybe that we could add on this one on oil demand, Laura, maybe see what you think, if it fits, saying your case for lower Chinese oil demand trajectory is compelling, but is India not just going to take its place as the engine of world oil demand? So I guess questions on Chinese and Indian coal demand, and then following that on oil demand and the shifting forces there. And then also a question, speaking of fossil fuels, from Philip Roos of, I think, of Energy Intelligence, saying several oil-producing countries are saying that the problem is not fossil fuels but CO2, and therefore suggests that carbon capture, utilization, storage, and removals can that they alone can solve the problem. Do you have any comments on this? And not to overload you, but there was just one question, a clarification maybe, from France Info, from Lauriane Delanoy, just asking if we could state when the peak in fossil fuel consumption comes in this decade in the stated policies. So just to clarify.
So thank you very much. Let's start with the uncertainties around unabated coal. So there is something that I would say is certainly not uncertain, and it's the fact that electricity demand in China and India is going to continue to grow very strongly. Now, the key question is how quickly will the countries be able to roll out the clean energy technologies, and whether this growth in clean energy technologies and generation will be sufficient to see those peaks in unabated coal. Currently, the manufacturing, for example, of solar is ample, but where we are seeing the difficulties is on, as he said, as Tim Gould mentioned earlier, is the grids, is the batteries deployment. So is being able to integrate this new amount of renewables in the systems. So for us, the uncertainty is going to be really about the ability of the countries to integrate the fast-growing amount of renewables. So if we are able to unlock the grid bottlenecks, if we are able to roll out batteries fast enough, then we would be able to see an even earlier peak in unabated coal use. If the electricity demand is going to grow faster than this rollout, then it will come later. The question about China versus India oil demand, will India overtake China as the main demand center? I think there is one number that illustrates well enough the point that the size of the Indian oil market is just a fraction, is around a third of Chinese oil demand today. So certainly we are seeing India oil demand growing and continuing to grow for the years to come, but China will in fact be the largest oil market in 2030 at around 19 million barrels a day. So it's just huge, and expecting that this shift and turnaround will happen this decade is not that yet there. Finally, on carbon capture, utilization, and storage, and its role in CO2 emissions and in abatement in general. Very clearly, we have been seeing CCS being a part of the solutions for many years. At the IEA, we have been talking about this. Unfortunately, when we track the technology progress, what we are seeing is rather disappointing. CCS is not growing as much as other technologies, as solar, as EVs. Certainly there is a role to play. We are highlighting this also in our net zero report, but it shouldn't be used as an excuse to abate CO2 emissions and fossil fuel use.
Thank you very much, Laura. So we've got time just for one last question. This one is for Dr. Birol, saying you were at COP21 in Paris, many other COPs. Now we're heading into COP28 in Dubai. As your report shows, time is running out for the 1.5 Celsius global warming goal of the Paris Agreement. Will enough be achieved at this COP for that? So Dr. Birol.
Yeah, I mean, this question is right in my view. This COP28 is as critical as the COP21 in Paris. When I compare the conditions going to Paris COP21, and when I look at the conditions today, there are definitely some advantages and disadvantages of the current context. If I can summarize, when we had Paris Agreement 2015, the good news was that there was a mood of international cooperation among the countries to find the solution of our common problem of climate crisis. So the major emitters, small countries, big countries, they came together, the leaders. It was a major topic and a common agenda for many countries. And when we look at today, COP28, for me, the single most important challenge is, instead of this mood and atmosphere of the cooperation, international cooperation among the countries, like in Paris 2015, now we see an international fragmentation of the countries. So for me, this is the single most important challenge among many other challenges and barriers. But there is also, of course, advantages compared to today, and when we compare today and Paris, today we have already readily available clean energy technologies which are cost effective. Solar, wind, electric cars, nuclear power, energy efficiency, many important clean energy technologies, and they are cost effective. We just need to expand them strongly. And when we had Paris, those technologies many of them were still in the beginning of being competitive and at rather small shares in the global energy mix. So to compare, there are pluses and minuses in the COP28 here, advantages and disadvantages. But as the International Energy Agency, we will do everything we can in order to have a good outcome from COP28. I think this is the last question, Jethro. If I can finish by thanking first of all the viewers here for following this event. My colleagues just told me that this event, about 1 hour now, followed by over 70,000 people across the world. Thank you very much. We are humbled with that. Maybe bigger than a major Champions League match, Jethro. We thank you all very much. And once again, I want to thank the two lead authors of this important report, Lara Kozzi, Tim Gould, and always the famous World Energy Outlook team. Thank you very much.
Dr. Birol, that is indeed all we have time for. As you mentioned, we've gone well over an hour over time to squeeze in as many questions as we can. If any journalists have questions that didn't get answered during the Q&A, please do follow up with us at the IEA press office, and we'll get back to you as soon as we can. I echo Dr. Birol's thanks to the report authors and also to the journalists for the excellent questions, and to everyone following along. A reminder that the full World Energy Outlook 2023 report is available for free on our website, iea.org. And there's a lot of great analysis and data in there to explore, so please do take a look. And that's all for today. Thank you and goodbye.